Okay, I think it's going to be the final video for paper 2 2025. Obviously, if people in future years will be like, why does he keep on going on about that? I'm not going to clip them. Hopefully, they just prove to be useful to people moving forward. But anyway, absorption costing income statements. Is it coming up in 2025? Yeah, why not? You watch this video and it's going to happen. And so what we've got six mark question to prepare the income statement and 1 mark to calculate the total production cost. This is quite nice. It's not too bad. So when we're looking at the production cost, it's only worth 1 mark because there's not a lot of work. Remembering that absorption costing is separating our costs into direct and indirect costs. So our direct cost is £6 per unit. The indirect cost of production is the overheads. They've said that we're budgeting for £22,000 per month, and we're absorbing that per unit. So on the basis of budgeted output, so per unit. So all you're going to do is 22,000 divided by 5,000. The overhead absorption is £4.40 per unit. So therefore add the two together, your total production cost per unit is £10.40. That is it. And you get a mark. The income statement then, so from an absorption costing point of view, you've got inventory valuation is based on that £10.40. You've got to calculate how many units there are. So the opening inventory, remember we're doing an income statement, sorry, for February 2021. So the opening inventory, with the fact that we sold 4,500 in January but produced 5,100. So we've got 600 units of opening inventory. The closing inventory, in February we sold 4,900, we produced 4,800. So that's going to drop to 500 units. So we've got 500 units of closing inventory. And then we can use those with all the other data to work out the income statement. So we'll look at the mark scheme just to show you. Okay, so the mark scheme's here. This shows you the workings for the £10.40. Gotta be honest, quite nice. So quite straightforward to get that 10.40 as long as you know how to do the absorbed overheads. You've got the revenue figure, so that was nice and straightforward. We went through on the previous part about where the 600 units of opening inventory were. They're worth £10.40, so that gives you the 6,240, which is your opening inventory. They've done an overall cost of production, which is 49,920, which is worth 1 mark. The only thing I would say there is if the fixed overheads weren't absorbed per unit, this doesn't quite work. If the machine hours and labour hours are not quite in line with budget or the expectations. So if you expected 2 machine hours per unit for 10,000 units, then it should be 20,000 machine hours. But what if it was 22,000 machine hours? So sometimes that could be slightly different. But essentially what we're saying is we've absorbed per unit, so it's nice and straightforward. We've produced 4,800 units. We've said in the previous question they're going to cost us £10.40 to produce, so therefore the overall cost is 49,920. The other ways you could have done the direct cost is times the £6 by the 4,800 and then demonstrated the £4.40 times the 4,800 for the fixed element, and they'll both add up to 49,920. It is absolutely fine to do it either way. The closing inventory, we said there were 500 units left, so they'll be valued at 10.40 as well. And we take that away to give us a cost of sales figure effectively of 50,960. This is not financial accounts. We don't have to have a label cost of sales, but no one's going to penalise you if you did, because that's essentially what you've calculated. So, like I said, if it was fixed overheads by machine hours, you would times your BOR, so your overhead absorption rate, by the amount of machine hours. This one was by units. If it was labour hours, it's by the amount of labour hours. Then you would have direct cost, fixed costs, or fixed overheads absorbed. Where we've got a slight differential here is the fact that we have charged, which is why I prefer doing it this way, we have charged £21,120 worth of overheads. Now, how have we done that? Is because we charged £4.40 per unit times by the 4,800, that is 21,120. The budgeted fixed overheads per month was 22,000, so that is 880 less than what we should be charging each month. I'll go through how they've worked out because you can do it either way, it's fine. So we've under-absorbed, we haven't charged enough. So we should have charged 22,000, we've charged 21,120. So we have under-absorbed. So you're going to get a mark for identifying it's under-absorbed, as long as it's in the right direction here, and a mark for calculating the right amount. So because of that, we're going to take away 880, it's an expense. If we had over-absorbed, so if we had absorbed more than 22,000, so if we had produced more than 5,000 units, because that's what we budgeted on, then we would be adding that as other income. So that would have increased our profit. So you can see here, out of these 6 marks, 2 of them are for that under absorption being treated correctly. That's quite nice. And then the remaining profit is own figure, as long as there's no alien items, of 41,260. So the over absorption, the other way we could look at it is because we have budgeted to produce 5,000. We only produced 4,800, so we're always going to under absorb then. Because if we produce 5,000, we're going to absorb the right amount of overheads. So we produced 200 less, or we budgeted to produce 200 less, which means we're not going to absorb enough overhead on current production. We want the top half of the income statement to be based on those budgeted figures. A bit like if you had incomplete records and you're trying to fit in with the markup or margin. If you're not sure on that analogy, please don't worry about it. And then we'll deal with the under or over absorption underneath. So it can be awkward absorption costing, but it's just that last little bit of under and over absorbed. Have we charged the right amount? And then add or subtract that. If you just included 50,960 as cost of sales, you would still get those 3 marks because it doesn't matter. It's not as fixated management accounts in that formatting, as I've said a few times. So that's one of those things. The differences between financial management accounts is the layouts and the expectations of those. Absorption costing, get those fixed production overheads into the cost of production, make sure inventory is valued correctly. Because remember, as the inventory goes up and our absorption costing, profit will go up because we're moving those fixed overheads to the next financial period as opening inventory. Whereas for marginal costing, we write off all those fixed costs in one period. Okay, good luck.